Microsoft's AI revenue just crossed a $37 billion run rate, but they're practically buying inflation right now to keep up with that demand. Welcome back to Earnings Unscripted. It is April 29th, 2026, and we are digging into Microsoft, ticker MSFT, for their third fiscal quarter. And honestly, Miro, looking at this print, I feel like I need a stiff drink.
Well, I mean, grab one if you need it. But before we pour, quick reminder to everyone listening that we are just two friends analyzing the numbers. This is for entertainment only, not financial advice, so do your own homework.
Exactly. Please do not buy a stock just because Miro sounds incredibly confident on a microphone.
I always sound confident. It is a terrible curse. But look, seeing this earnings drop, you completely understand why the market is having an identity crisis with them right now.
Oh, the After Hours tape was absolutely wild.
Right, it was a heart monitor. The stock was down, almost 26% across the fiscal quarter, just a steady grind lower. And then they dropped the release today. The stock swings violently from 387 up to 440 and then just settles right back to flat. A 0.78% drop from yesterday's close. The market has absolutely no idea how to price this company right now.
They really don't, because on the surface, the headline numbers are actually incredibly solid. Total revenue hit $82.89 billion, up almost 2% from last quarter. And the bottom line, non-GAAP earnings per share came in at $4.27, which beats expectations and is up nicely from $4.14 in Q2.
Yeah, and operating income is sitting at $38.4 billion. So it is this massive, highly profitable cash machine. But the thing that caught my eye immediately is where the internal gravity is shifting. Intelligent cloud revenue hit $34.68 billion.
Right, which is up over 5% sequentially.
Exactly. It is actually out-accelerating their core productivity suite now in pure sequential growth, which is crazy when you remember Microsoft is supposed to be the company that just sells you Word and Excel seat licenses. Now they are basically an industrial AI utility company. But to get that growth, the physical constraints they are facing are getting terrifying. We always talk about the cloud like it is invisible, but they are out there pouring concrete.
Oh, sorry. Actually, they are crushing those physical constraints right now. Did you see that note about the Fairwater data center out in Wisconsin?
I did, yeah. Brought online 6 weeks ahead of schedule.
Right. And Satya Nadella mentioned their, quote, dock to live times have dropped nearly 20%. So literally the time it takes for a wildly expensive new GPU to roll off a truck at the loading dock, get plugged in, and actually start processing a customer query is shrinking. That is just incredible operational execution.
It is impressive. It really is. But I mean, they kind of have to run that fast because the legacy stuff is starting to drag. More personal computing revenue was actually down 7.4% quarter over quarter. The hardware side, Xbox content, it's just kind of lagging while the AI business consumes all the oxygen in the room.
And all the capital, quite frankly. We're looking at a highly profitable quarter with over $46 billion in cash from operations, sure. But they just warned about an upcoming capital expenditure pipeline that is going to completely break the old software margins model.
Which I think is the entire story here. They are aggressively buying growth, but the price tag on that hardware is inflating incredibly fast.
Definitely. All right, let's get into the details on that CapEx guide.
So this is where the math gets genuinely uncomfortable. They guided for, I think it was roughly $190 billion in CapEx for calendar year 26, which is basically the GDP of a small country.
Right. And a massive chunk of that is just short-lived assets, GPUs and servers.
Exactly. 2/3 of it, actually. But the piece that should genuinely terrify people is what that money is buying. Out of that 190, $25 billion is purely from higher component pricing.
Wow. Okay, so that is just a pure $25 billion inflation tax. They are not even getting extra compute capacity for that.
Nope. Amy Hood explicitly called it out. Quote, "We expect to invest roughly $190 billion in capital expenditures, which includes approximately $25 billion from the impact of higher component pricing." Unquote. It is a silent tax on the entire AI ecosystem.
Sheesh. That makes perfect sense why the Microsoft Cloud gross margin dipped to 66% this quarter. The physical bottleneck is not just getting enough chips, it is that the chips are getting substantially substantially more expensive.
Yeah, memory costs, silicon, all of it. And when you face that kind of raw physical constraint, it kind of forces you to change the software model.
Right, which brings us to GitHub Copilot, because starting June 1st, they are moving away from flat, seat-based licenses and aligning pricing purely with usage.
Which is a massive paradigm shift for them.
It really is, because investors absolutely love predictable, recurring revenue. They love per-seat subscriptions. But when you move to a usage model for AI, you are essentially admitting, hey, this thing eats so much expensive compute on the back end that we cannot afford to give you an all-you-can-eat buffet anymore.
You definitely can't when your hardware bill has a $25 billion inflation premium. But look, it's the only rational way forward. Copilot seats are up 250% year over year, over 20 million paid seats now. You just can't run a flat subscription when enterprise clients are building autonomous agents that constantly query databases.
Oh, perfectly said. Satya actually mentioned HSBC used Copilot to build custom agents, and it slashed their issue resolution times by over 30%. So the utility is undeniably there. You just have to capture that value differently now.
Exactly. And Hood made that very point on the call. She said when you move to usage-based models, you have to make sure you're delivering incredibly high value. They know it's risky. They even noted some Dynamics bookings are already getting a bit wobbly as customers try to balance traditional seats versus this new consumption model.
Which means they need margin relief from somewhere else. And I think that brings us to the OpenAI restructuring. This flew a bit under the radar, but it is huge.
It really is. I was actually surprised how casually Satya mentioned it. They completely reworked the deal.
To what, exactly? Because they were locked into a pretty heavy revenue share before.
Well, they eliminated the revenue share almost entirely. Satya said on the call, quote, "We have a frontier model, royalty-free, with all the IP rights that we will have access to all the way till 2032, and we fully plan to exploit it," unquote.
Royalty-free? That is incredible. They just erased the toll booth.
Precisely. They turned OpenAI from a profit-sharing partner into pure infrastructure, which is just brilliant capital allocation. You eat the hardware inflation, but you permanently remove the software licensing drag.
We fully plan to exploit it. That is such a rare choice of words from Satya. Usually he is all about empowerment and empathy, but that is just pure capitalist utility.
Yeah, well, it is very clear who holds the leverage now. But here's the thing. Even with that OpenAI fix, the math is still brutally tight, which I suspect is why we are suddenly seeing this $900 million restructuring charge for Q4.
Oh, right. The voluntary retirement program. $350 million hitting COGS and $550 million in OPEX. That came out of nowhere.
Did it, though? You have massive thermal runaway on CapEx. The only lever you can pull quickly to preserve the bottom line is headcount. It's an aggressive flush of probably older, pre-AI engineering talent.
Wow. So they're essentially right-sizing the non-AI workforce to help fund the server farm.
That is exactly it. The cloud is literally consuming the legacy business.
That is darkly poetic, Miro. So with all this massive internal reshaping, plus these very real hardware constraints, where does this leave them heading into the next quarter?
Well, they are projecting some serious top-line strength to power through it. They guided for Q4 revenue right around $86.7 to $87.8 billion. That is roughly a 13 to 15% growth trajectory. So the core demand engine is still absolutely firing.
Right, but we still have to see how that $900 million restructuring charge actually hits their operating structure next quarter. Because when you zoom out to calendar 2026 and they're staring down a $190 billion CapEx plan, it just feels like we are witnessing a completely new era of corporate scale.
It is. It's industrial ambition disguised as software. But the fascinating thing is that management seems completely unbothered by the sheer size of those numbers. Amy Hood explicitly stated on the call, quote, "We expect another year of double-digit revenue and operating income growth at FY 2027, unquote.
They're basically telling Wall Street to just trust the process.
Yeah, trust the process because the alternative is getting left behind in the tech cycle. Although you do have to keep a close eye on that hardware inflation we talked about. If PC memory prices keep climbing, and their legacy consumer hardware stays sluggish, they're going to be fighting gravity on two separate fronts.
That is exactly the tension to watch. You have to wonder how long they can aggressively fund this sci-fi future while managing a very tired legacy computing market. It's going to be a fascinating tightrope walk.
A very expensive tightrope. I think I'm actually getting a little vertigo just thinking about the scale of these physical investments.
I think we all are, but that's probably the perfect place to leave it for today. They build the data centers, and we try to make sense of the math.
That's the arrangement. Let's call it here.
Thanks for hanging out with us, everyone. Catch you on the next print.
If you want these kinds of earnings drops to just organically show up for you, feel free to give the show a follow. And just as a quick aside, this is actually an AI-generated podcast, which is really the only way we can read and synthesize hundreds of pages of corporate filings this fast. We'd love to hear from you. So if there is a specific ticker you want us to dig into next, just drop us a line at earningsunscripted@datamadness.ca or catch the X link in the show notes.
We'll catch you on the next.